All right, good morning and welcome to PACT's Raising Capital in a Pandemic event. We are excited with this morning's speaker panel, and I want to welcome you all. I'm Dean Miller, the President and CEO of PACT. And as you know, one of the areas that we focus a lot on, in addition to talent, customer relationships, is capital. Just about a week ago, we issued the capital report for 2020 that we did in partnership with PitchBook and Bridge Bank. And this is really a continuation of the conversation, specifically with a couple of our most successful entrepreneurs over the past couple of years, as well as investors. And I, again, want to welcome you to this event, sponsored by Bridge Bank, Saul, Ewing, and British Columbia. Couple ground rules. We are obviously in a Zoom format. Attendees are muted with no video. We ask that you use the Q&A window to ask questions. We will monitor that throughout and make sure that your questions get answered. You can also use the chat function to comment or message with individual attendees. We're going to take about 60 minutes, and then we're going to head to a virtual networking lounge for informal face-to-face networking. And you'll look for that link in chat. If you haven't used Remo before, it's a wonderful platform to enable you in a virtual world to really connect with people. So without further ado, let me introduce our moderator. Chad Williams is a partner with Saul Ewing, where he helps to lead their corporate practice. He's a longtime supporter of PACT and a part of our community broadly. Welcome, Chad.
Morning, thank you, Dean. Good morning, everyone. It's a pleasure to be with you today, and I'm really looking forward to our panel and hopefully a lively discussion. We'd like to welcome you to include your questions in the chat room. We'll be monitoring that, and we'll try to intersperse those questions and comments throughout the presentation. It's my honor to introduce our panel today. We've got Tristan Handy, who's the founder and CEO of Fishtown Analytics. Fishtown has developed an open source data tool that allows data analysts to create and disseminate organizational knowledge throughout their company or their companies. And they just recently closed a $30 million Series B that was led by Sequoia. We also have Emily Foote, who's the principal with Osage. Emily brings a diverse background to her practice as both a founder, prior founder, and now a principal with the venture fund. And we're looking forward to Emily's input from the investor perspective. We have Bob Moore, who's a co-founder and CEO of Crossbeam. Crossbeam has developed a software as a service platform that helps companies securely share data to build and improve intercompany partnerships. And Crossbeam also recently closed a Series B that was led by Redpoint Ventures. Next, we have Chris Busby, who is a partner with GreatHill Partners. And Craig focuses on digital infrastructure and software investments with early stage and growth companies. And last but not least, we have Matt Klinger, who's a senior director in technology banking with Bridge Bank. Bridge Bank, as I'm sure all of you are aware, is a well-known lender in the space and a partner to investors, technology firms, and all the players in financing transactions. And as Dean said, my name is Chad Williams. I'm a partner with Saul Ewing, the corporate practice group, and it's my pleasure to kind of moderate and lead the discussion today. So we've focused our thoughts here today on a couple of different areas. First is the process of raising capital in the midst of a pandemic. So obviously March 2020 kind of rocked the world, but as entrepreneurs and business owners do, you kind of pick yourself up and quickly figure out how to adapt in a new environment. And everyone around the financing ecosystem had to do the same thing. And so we'll talk a little bit about how the process changed for better or worse during the last year, some best practices that may have developed and some things that we've learned. Next, we'll talk about pandemic specific issues. So things that have come up that are unique to the environment that we were in during the last year, how those affect both operating and growing a business in this environment, as well as investing and deploying capital in this environment. And then last, we'll talk a little bit about the competition in the capital markets, which is really a more kind of high level discussion. But in light of the last year, the fact that there remains a significant amount of capital looking for high quality deals. We'll talk a little bit about what competition in the market looks like, how that affects the perspective of both company founders and CEOs, as well as investors and lenders in the market. So without further ado, we'll jump right in with respect to the process of raising capital during the pandemic. And I think where we'd like to begin is at the beginning with respect to outreach. And in a traditional environment, going out and raising capital, you may hire an intermediary, you may work with existing advisors to help facilitate introductions. Founders and CEOs typically have built a network of prospective investors, and likewise investors have built a pipeline and relationships with prospective companies that they'd like to invest in. And there was sort of a well-tread path of how that worked prior to the pandemic. I think we've got two phenomenal companies here who both closed tremendous rounds during the pandemic, and both have unique stories about how that happened. And so why don't we start there? Tristan, maybe you could share a little bit about your experience with Fishtown and sort of how things transpired during the last year and what that experience was like for you.
Yeah, I'm happy to do that. You say that Bob and I have unique experiences. I think that aspects of both of our stories are unique in ways that, like, I don't know that everybody should take them as representative and say, like, well, this is definitely what you should shoot for. So I just want to, like, have that caveat out there before trying to tell our story. We started as a professional services business and back in 2016, and developed an open source tool that over time developed a bunch of traction. And over the years, we had conversations with investors about potentially raising capital, but it never pursued it aggressively. It was just like a thing that, when people reached out, we would have the conversation. And as our open source community grew, that inbound got more and more serious. And at the same time, we could see a clearer path towards, like, wanting to deploy the capital. So for us, it was just like a steady build of inbound interest, and really, like, never left home the entire way, and never even, like, created like a strategy around this. It was more like saying yes at the time that it made sense for the business, as opposed to, like, trying to, like, put a timeline together and a process together and, like, go out and run that more proactively.
Were you concerned at all about losing the competitive effects of running a more formal process, where instead of going direct and negotiating with groups that expressed an inbound interest, did that weigh into your decision making at all?
It did, but the funny thing is, when, as a bootstrap company, we had to be profitable, right? And so what you're trying to do when you run a process as a, like, traditional venture-backed company is you're trying to create a competitive dynamic in a defined time window. And so what we did, instead of creating a competitive dynamic across, like, a variety of market participants, what we did was we allowed time to be the dimension that we had like created competition. So, like, if we were not excited about the deal on the table, we would just say no, and we would go back to running the business. And so we like forced people to meet a floor often against themselves, where we would like actually consider the deal on the table.
That's great. That's helpful. Bob, what was how does your experience compare to Tristan's?
Yeah, I think it was similar in that it was a preempt, meaning that the firm that we ended up working with, it kind of came to us in advance of us trying to run a process or go actively pitch a big field of investors. I think the thing that might be different is that I probably maybe spend more cycles than I should of my CEO time thinking about investor relationships and kind of like cultivating, almost like trying to craft the narrative around why our next round will happen in advance of that round, even when we're not actively fundraising.
Bob's the real pro here. Sometimes when I talk to him about fundraising, I feel a little bit like Forrest Gump. So yeah, you should listen to him.
What's funny is that I think it's like, so I started my career at a venture capital firm at Insight Venture Partners in New York. And I think there's a part of me that just has like I follow a bunch of VCs on Twitter, probably too many of them. Like I internalize a lot of what is going on in that market as just kind of like enjoyable, digestible content, because I kind of geek out on that space and like the career path of people that are in that space and what just kind of over empathizing with people that are in the VC seat. And in the course of doing that, I think I'll end up spending a lot of time just, trying to be very strategic about not spending an overwhelming amount of time talking to venture firms when we're not raising, but also not wholesale neglecting those conversations either. So I keep a fairly lightweight like CRM system of all the venture folks that we've been connected to in one way or another. Sometimes it's because our existing investors think we really ought to try to be on the radar of certain people. So it's got a little bit more of an outbound to it. Sometimes it's an inbound motion where people become aware of us because they've got a portfolio company that's a customer or something like that. But just try and keep tabs on, like, if I tell everybody, hey, I'm heads down, let's talk this summer, and then summer rolls around, I'll actually do the calls rather than kind of punting them out. And I'll say, okay, I'm going to do, 20-minute, 30-minute calls with a half a dozen people this month. It's 3 to 5 hours, even though I might not be planning to raise for another 6 months or 12 months. And if you keep kind of a steady pace of those, it just makes it so that if you do get somebody that is preemptively coming in the door and they're not necessarily your number one choice, or the terms of that deal are not exactly what you want them to be, either directly or through implication, you have leverage in that conversation, because you know that there are a lot of people that have been kept up to date that are going to feel a personal attachment to the business, that are going to be able to say to their partnership, hey, I've been tracking this for 9 months and I've had 3 calls with the CEO, and it's not like this deal just spontaneously appeared and we're competing on price. This is a relationship deal. So I think like being able to make investors authentically feel like if they do a deal with my company, it's a relationship deal, puts it in a different headspace in a lot of cases, as opposed to it just being like a white hot, super competitive, crazy deal. And I think some of that mentality grows frankly out of, in past companies, Tristan and I met working on this company, RJ Metrics, together. And like, man, we struggled fundraising there. I mean, we did a Series A and a B there, but we also tried to do another Series B prior to the one we successfully raised that was a total strikeout, where we got passed on by 30 or so firms. And then we tried to raise a Series C before we sold the business and weren't successful in doing that. And I think a lot of the lessons learned from those pain points were around, don't just come calling when you need venture firms. Like venture firms need to, stay alive and stay abreast of your business. And there's some reciprocity there that's super important. So I guess plan for the worst, hope for the best kind of mentality, I guess. And that's really a roundabout way of saying, when we did our Series B with Redpoint right in the height of the pandemic, this is a relationship where I had known the investor there for years, dating all the way back to RJ Metrics, and kind of occasionally kept in touch with him. He was actually at a completely different firm than he was at than when I originally met him. But the stars kind of aligned and they got aggressive, and we were able to negotiate to what we wanted because we knew we had the option to go elsewhere if we didn't take the preempt. And I think that really helped.
That's great. That's helpful. And it sounds like in both cases, your kind of prior work developing those relationships really helped facilitate the process in what might have otherwise been a difficult fundraising environment. Well, it'd be great to hear from our investors on the panel and from our lender on the panel in terms of your pipeline and how important it was to have relationships from your perspective heading into the pandemic and then during the pandemic in terms of generating new opportunities and getting in front of companies. Emily, maybe we can start with you. What was your experience like with Osage, understanding that you'd recently joined, and so you've jumped right into the fire.
Yeah, I joined on March 2nd, so I don't have much of a context of pre-pandemic what it was like, but I do like data, and so I understand kind of what we were doing before and what it looked like. So for Osage, as I'm sure it's very similar for many venture firms, there's multiple avenues of where the deal flow is coming from, and kind of our three most successful ones, meaning, you know, measured by how far companies get in the pipeline. So second meeting with the investment team, typically come from other investors, so the larger ecosystem, from events, and then from our own outreach, not dissimilar to what our portfolio companies do from a sales outreach. And it was interesting, so when you look at the year-over-year data of what was happening in 2019 versus 2020, events decreased by 64%. Other inbound leads from other investors decreased by 25%, but our own personal outreach increased by 11%. And that's, I think, you know, a reflection of our intentionality with the outreach and the system we have, but also just there's been a, you know, tremendous rise in institutional seed investing. And so outreach to those investors have been really a growing source of opportunities for us. But it's interesting coming into this world because it's, you know, so network based. And when you have a world that the traditional form of networking has stopped, you have to think, you know, how are we going to adapt and change to increase that networking? In my past lives, you know, I think I'm good at building relationships. I've never been, and I probably should have been, I think I'm more like Tristan than Bob. I was never, as an entrepreneur, that methodical and thoughtful as Bob was in terms of building those VC relationships. And similar in this world, you know, I've built relationships, I think, more off of like spontaneity of meeting people at events or going that way. And I've coming into this world as an investor, recognizing how critical your network is from a deal flow perspective. I've had to do things that are slightly out of my comfort zone. So if you look at my LinkedIn, I never posted pre-pandemic. I was just like heads down working. But now I'm like posting because I recognize that, oh, people, you know, in my network may not know I'm in this world now. And so maybe that's helpful. Or when I go on virtual events, I'll consciously reach out to investors that I think would be interesting to make relationships with to hopefully share deals. And that's slightly uncomfortable for me, but I recognize that in this new world, that's kind of what you have to do to increase that number that did decrease, you know, year over year from 19 to 20 in terms of deal flow from investors, which are typically, you know, a really strong source for us.
Yep, that's great. Matt, in your experience, you know, pre-pandemic, I'd imagine a lot of deal flow came to you through other intermediaries and other players in the space. Did it change for you dramatically during the pandemic? And if so, kind of how did you adapt at Bridgebank?
Yeah, I would actually say it didn't really change too much. You know, we would get a lot of deal flow from investors, as well as other service providers in our area, other mezzanine lenders. And so honestly, that didn't really change too much. You know, our pipeline was pretty strong going into the pandemic. Obviously, as a bank, we paused for a couple months to process PPP loans. But once we got through that, you know, I was skeptical on how our pipeline would look. And honestly, it was much bigger than I thought, and the quality was much better than I thought. And I think that's a testament to a lot of companies, you know, really hunkering down, doing the right thing. You know, if they needed to raise additional capital to put some liquidity on the balance sheet, doing that, but also being, you know, very cognizant of their bottom line with the obvious unknown. So you know, I would say our pipeline was just as strong, if not stronger. You know, we didn't really pull back from the market other than obviously just needing to process PPP loans. But once we got through that, you know, we were in the market, we were doing the same kinds of deals. We were obviously being cautious about how we underwrote. But, you know, I would say deal flow was just as strong, if not stronger, honestly.
Great. Chris, would love you to weigh in on that as well. And in addition, maybe you could share a little bit about how, if at all, the pandemic changed your evaluation process on the front end. So were you able to take a look from introduction to a company or outreach to a company to the point of deciding whether it was something of interest? Did the evaluation and analysis process change at all for you in the pandemic?
Yeah, I think, first of all, just to put it in context, we play a little bit beyond what I call the classic venture stage, where we would define ourselves as a growth equity investor, but about 2/3 of the deals we do are control deals as opposed to minority deals. And our minimum equity check size is about $50 million, and our sweet spot's kind of between $100 and $200 million of equity. So the companies we're investing in are a little bit further along in their journey. And I think it's important to highlight that our approach is very thematic in the way we go to market. So we're trying to identify specific sectors or even niches within those sectors that we think are benefiting from some sort of a rising tide that will play out over the next 5 to 10 years, develop relationships with all of the companies that we think are winning in those markets, and understand who's winning and why, develop those relationships well before they come to market. So I think that is helpful when something like a pandemic happens for us, because we have this kind of backlog of relationships that we've been building over the previous years around companies and sectors that we know and like. And so, across our firm, over 80% of the deals we do have been with companies that we've known for over 3 years before we make those investments. And if I look at the deals we've done over the last 12 months, 100% of the deals we've done have been with companies we've known, or at least management teams we've known for at least 3 years. I think that helps us have a little bit more conviction around not the thesis, but the people we're getting into business with when you have that long-term relationship. And I think what Bob said certainly really also resonated for me from the other side of the table. We recognize that we live in an extremely competitive environment as it relates to deploying capital. There is no shortage of capital out there. And every day there are new participants, particularly coming into these growth technology sectors, because it's one of the areas that has held up best and delivered the best returns. And so if you show up to a deal and you've never had any interaction with the company before, don't know the sector well, if you're moving forward in the process and you win, I think you have to ask yourself why. And so to Bob's point, I think if you have that relationship, if you feel like you have an understanding of the business and the people, it at least gives you some comfort that you have some angle, that there's some reason why you are willing to pay more than the next person to buy that company or invest in that business. And I do think that, at least from where I sit, it's very difficult to make an investment if you don't feel like you have some bedrock of that relationship going in. Once we're in those conversations, I would tell you that, frankly, the evaluation process did not change as dramatically over the last 12 months as probably I thought it would have in late March or April. Obviously we were all very confused around where was the world headed a year ago. But as things played out, certainly in the latter half of 2020 and into 2021, the playbook from an execution perspective is relatively similar to what the playbook was before. Clearly, it's more Zoom and less face-to-face. But in some ways, I think that has actually, it has been a positive in some ways. When you're trying to close a deal, the CEO is always just a button away. And so you want to dig in on any question, any area. People are just more available, and you don't feel like you have to get on a plane and fly 6 hours to have a conversation. It's a conversation you can have a few times during the course of the week as you're trying to figure out the key elements of your diligence plan. So that has been at least our perspective thus far.
Great. That's great. That's very helpful. So I think next we'll kind of batch the rest of the process. So let's say that, you know, we've gotten through that initial outreach and introduction period, and the company is accepting term sheets, LOIs. Let's talk a little bit about the diligence process, the negotiation process, and timing from kind of term sheet to close, and how any of those things may have changed for better or worse during the pandemic. Why don't we start with Matt? You know, you talked a little bit about PPP loans and the market's response there. What was your experience from a diligence and timing perspective in terms of once you got involved, helping to facilitate getting deals closed?
Yeah, it's a good question. So I think it's important to know, for those out there that don't, is that typically our capital is used for one of two things, right? It's usually used for acquisition financing, right? Or it's used for growth capital, right? So when you look at the acquisition side, obviously that side we have to move a little bit quicker, right? And so we will move as quick as the data can be provided to us, because there is a timeline there, right? And so that was an interesting situation where, we saw a lot of companies expecting to take advantage of this pandemic and acquire more businesses. And I think what we found is that the PPP loans actually did a really good job of doing exactly what they were supposed to do and helping companies get that runway to get through the pandemic, excuse me, get through kind of these unknown elongated sales cycles that they were in on the customer side. And so there weren't as many companies actually looking to transact as we had all expected, I would say. And because of that, I think valuations got pretty frothy and still are pretty high. So we actually didn't see as many transactions on the M&A side, but on that side, we obviously have to move very fast, right? On the growth capital side, frankly, it really just depends. It depends on, whether they're running a process, whether we're just kind of having a one-off conversation. Typically, those growth situations, we're piggybacking on an equity round. And so I would say we have gotten more efficient, right? I think to Chris's point, now that we have a very known playbook because all this is virtual. We did a lot of deals last year. We actually did in our office in the Mid-Atlantic, we did a dozen new logos last year, which is a lot considering that, really we took Q2 off to process PPP loans. So it really is over 3 quarters. And so to be able to do that kind of volume with a small team, we have to be very efficient. And I think we've been able to do that in a virtual environment. Now, what's not lost on me though, is, much like what Bob and Chris said, is that we really like to develop these relationships because the idea is we do a small loan to begin with. And as that company grows, we are growing that facility, right? As they're continuing to raise equity, they're using our facility, as supplemental capital, right? That they can use to kind of help bridge to the next round later on. And so, I would say I'm a little uncomfortable with the fact that, the relationships are not as strong as I would like because we haven't met most of these companies and teams in person. Now, I have the benefit of being able to lean on people like Emily and Chris, right? Because they've done much deeper diligence. They've known these teams longer. And so I have that benefit. But in terms of the long term, it's something that I don't like as much because my relationship isn't as strong, right? We expect that there's going to be bumps in the road as these companies are continuing to grow and burn capital. And so, we are able to move fast, which I think is good in the short term, but in the long term, I'm cognizant that, there needs to be a relationship there that needs to be developed in person, right? Once the world opens back up. So to answer your question, I think, yeah, we've been able to act a lot faster, right? Especially in competitive situations and with M&A. But you could kind of look at it as maybe that comes with a little bit of a cost.
Yeah. So thanks, Matt. And Tristan and Bob, I mean, you each closed rounds really right in the middle of the pandemic. I think Crossbeam closed its Series B in August, and Fishtown in November. Maybe you could each share a little bit about your experience. I know, and Tristan, you shared some anecdotes in terms of even being able to meet in person, if only briefly during the process. But maybe talk a little bit about, as you're responding to a crisis, essentially in the market, and trying to navigate your business through that, how your attention and focus, was spent on the financing transaction. And it seems that in both cases, you were able to get things done relatively quickly. Was that something that you were driving the timing on your end, or did you get the sense that your investment partners understood that, look, this can't be a distraction at this period of time?
I think it gets a little bit back to the frothy market and the preemption part of this. Like, when you get preempted, one of the things that most investors will say to you that is a part of the sales process is like, we can close this really fast. And so our B from term sheet signed to like cash in the bank was, I don't even know, it was like 2 or 3 weeks. It was like a very small amount of time. That we actually, the more interesting story for us is the where we pitched in person in the end of February, and then I think cash in the bank was like first week of April or something like that. And so like in the interim, that is when the world closed down, and it was not the kind of situation where like we were working against a clock, and if we didn't close that the business was going to cease to exist or anything like that. But it was tremendously stressful, as like it was certainly the most challenging period that I've ever had to deal with as CEO. And at the same time, you have this like big binary event, like either this is going to close or it's not, and that it's like very different paths for the company. And honestly, the thing that was really critical for me there is that I had met Martin Casado of Andreessen Horowitz in person twice when I was out in California in February, and we'd established a really strong relationship. And I woke up one night like unable to sleep, like, are you folks going to be able to close? Like, are you, is this a 2008 style like economic collapse, and you're literally like your capital calls are not going to come through? And he like did a great job of just like, this is fine, everything is fine. Your deal is very small relative to our fund. It will be fine. And I think that relationship was very important as I continued to focus on the business and not the capital raise. Like that kind of like happened, and I needed to focus over here, and I was able to do that.
Great. Bob?
Yeah. I'm glad you mentioned 2008 because I think that was on my mind as well. And if you look back so we had raised the Series A back the previous July. So when the pandemic hit, we were less than a year, approximately 9 months into deploying that capital. That money had kind of been earmarked to last, 24 to 36 months. So we were still in the early days of putting that money to work. So, it did give us, when the lockdown started to look like it was not going to be just a 1 week vacation for everybody and was going to be something more longstanding, it gave us a little bit of this ability to look at ourselves and say, okay, the business isn't going to go away, but the way that we manage it might need to change. And I think potentially because I had gone through struggling to fundraise and build a business in the 2008 era, I had this very gut reaction that was almost like born out of scar tissue from that experience, which was, let's just pause all of our hiring. Let's just look back at the model and see what it means to, if this is something that, creates exactly the kind of crisis Tristan was talking about, something where literally capital physically cannot be deployed due to constraints in like the financial system. how are we going to survive? How are we going to make payroll? And what was remarkable is how wrong that base assumption was in terms of trying to use 2008 as a standard for comparison in terms of what was actually going on in the economy. Because what happened was that the constraints that were imposed on the economy were really constraints on supply rather than demand, if that makes sense, in terms of how venture capital flows out. Like many companies, that were potentially in the technology space, but may have been focused on travel or events or other things that were more bound to the industries that were hit harder by this, ceased to be good venture candidates. And meanwhile, the amount of capital available out there in the system through, a combination of, quantitative easing by the Fed and, just other categories of investments not being as appealing, suddenly the dollars available liquid in the private equity markets, including, early stage VC, were just bigger than ever. So what you had was just this huge amount of capital that was specifically laser targeted on companies that could function remotely and could be force multipliers for businesses that operated in the digital world, which was really the only place that growth could be found in this window. And we had the exact opposite of 2008, which is that it wasn't a liquidity crisis, it was a liquidity surplus. And suddenly, in our Series B process, we've got hedge funds pitching us right alongside early stage VC firms, right alongside growth stage VC firms, right alongside shops trying to offer venture debt. And I think that we had a reversal on our reversal by May, which was that not only did we have cash in the bank, but we thought that there were going to most likely be some opportunities to do, an above market deal by the middle of the summer. And once we kind of popped our heads up and were open-minded about doing that deal came to fruition. So, again, to echo Tristan's preamble here, like the stars aligned in a lot of ways that were probably not through some divine vision on our part around creating a company that was a little bit pandemic protected or even set up to grow faster in a constrained environment like that. But that's the way that the dynamics played out. Very, very, very different than 08.
Yeah, great. Chris, given your focus a little bit, later stage, growth stage companies, how does that compare to your experience on the investor side in terms of timing from LOI term sheet to close, and specifically in your diligence and evaluation process, the unknown of how long the pandemic would last, what the effect would be on the financial performance and growth of the companies that you were looking at? How did that factor into both your substantive process as well as sort of just timing in general?
Yeah, I think early in the pandemic, things got real quiet in our world. And I don't know how much of that in terms of new investments. And I don't know how much of that is everyone just kind of taking a step back and saying, don't know exactly where we're headed over the next year. But I think there was also a refocus on the portfolio. I mean, we obviously have well over 30 portfolio companies that no one knew what 2020 was going to look like sitting there in April and May. And so there was a refocus, making sure that the companies were making the right decisions for their long-term health. And it really wasn't, I don't think, until, for at least for us, kind of that summer time frame where we started to realize, wow, like bookings are actually much better than we ever would have anticipated. The companies are performing well ahead of our reforecast that we all did in that April and May timeframe. And it allowed us to again, refocus out on who's winning in this market and where can we find opportunities to deploy capital. And again, I think to Bob's point, the market for companies that were winning became absolutely red hot. You just had, because there's clearly a subset of businesses that are performing well in that environment. And not only do you have all the usual investors who want to invest in those sectors, but now you have lots of other investors who are saying, this is the only place I can deploy capital. So that supply, demand, and balance started to happen in the second half of 2020. And it is still raging right now. I mean, the amount of capital chasing deals right now is remarkable. It's driving valuations up in a meaningful way, and particularly around, I think, technology, particularly it seems to us in the B2B enterprise software technology world. People look at the performance in 2020 and say, wow, that segment really held up. It pulled forward, I think, a lot of trends that folks thought would take 5 to 10 years to play out. And now it played out in about 6 months, maybe less. And you just have, again, so many folks coming into this market that as an investor, you have to figure out, where am I going to pick my spot? And frankly, I'm probably going to do something to win. I'm going to have to do something that feels a little uncomfortable from a valuation standpoint, because frankly, valuations have to be competitive. You have to really lean in. At least that's the world we're seeing today.
And I want to come back to that in a bit, because I think that will, that's sort of plant seeds that are going to eventually come about, months and years from now, and we should talk about what that looks like on the other side of this. Emily, one of the things that Chris mentioned was really taking the opportunity to work with existing portfolio companies and help them navigate through the crisis. Maybe you could talk a little bit about what Osage did in that environment, and sort of how you've helped your portfolio companies work through some of this.
Yeah, sure. So we, very similar to what Chris just said, we, when the world shut down, we took a step back to refocus on our 30+ portfolio companies. We didn't stop investing. We made our first investment pre-pandemic in May, but we really focused on, okay, what do they need to either take advantage of the opportunities that are coming to them, or to hunker down, as Bob and Tristan were saying, is this going to be analogous to 2008? The interesting thing with us is that we're B2B software investors. Like Chris was saying, after the fog kind of lifted, the digitizing your company became the top priority for every single executive. So our companies, we invest in, future of healthcare, future of work. We invest in next generation cloud or AI for productivity tools, et cetera. So majority of our portfolio companies were, priorities that CEOs were looking at. So it really was after kind of the initial weeks of, okay, how do you navigate? Let's help them with PPP, whether they should take it or not, et cetera. How do you sustain these long sales cycles that a lot of companies are also hunkering down? We really focus on how do we take advantage of the opportunity, because we have solutions that can really help these companies transform from a digital perspective faster than maybe they were going to do, in January of 2020. And then I think just the last thing to say is that this is going to sound so cliche, but I think we, as everybody on this panel, really believe in the power of communities. I mean, look at what the scientific community did from a perspective of coming together with creating a vaccine in 11 months, as opposed to 4 to 20 years with, Pfizer and Moderna and the whole community coming together. So we really brought our community together. So we brought our CEOs together to talk about remote work. We brought our sales leaders together multiple times to talk about, okay, how do you sell in a world that is shut down from a purchasing perspective right now? How do you foster those customer relationships, which is something that I focus on, just because my last role, I headed customer success over at Instructure's corporate side. So that bringing that community was really helpful during those times. But then it, quickly turned into, similar to Bob and Tristan with investment, is, okay, how do we take advantage of this opportunity?
Yep. Great. That's interesting. So I want to shift to kind of addressing some pandemic specific things that arose, some lessons that were learned. And I know we only have Tristan for a bit longer, so I'm going to start there. Tristan, in terms of, I know that the company, as with everyone, sort of in March, April, when there's uncertainty, you're getting your bearings. But it sounds like from our prior conversations that The business itself operated pretty smoothly during the pandemic, but maybe you could talk a little bit about how, if at all, the pandemic has affected financial performance, but positively or negatively, and then anything that's come out of this from a crisis management standpoint, from an operational standpoint, in terms of where you see the future of building teams in this environment and a distributed workforce, kind of anything that you've learned over the last year that you think is something that's going to last beyond the next 12 months.
Yeah, that's a big umbrella. I'll try to hit some high points. Financial performance, Emily was just talking about this. We're very fortunate that we fall into the category of the economy where we just did not, we're not Instacart. We didn't see orders, quadruple over the time period, or we also didn't see meaningful churn to our subscription business. So I think it was April, we saw 4% churn, which was our next highest month ever was like 0.5%. So that was like a little stressful to us, but then the very next month it went back to like normal, and it stayed there for the duration. And I think that was just related to small businesses that like literally didn't exist anymore after the tumult in that period. But otherwise, financial performance has been either unaffected or slightly positive. I think that because we still have a small team, the switch to Zoom has enabled our sales folks to have real sales conversations with like large organizations without going on site, without going through the whole dog and pony show that you sometimes have to do in enterprise sales. And that's probably enabled us to punch above our weight in some contexts. But I honestly think that the bigger stuff for us and for me personally is like, what does it mean to lead in this context? And everybody here is actually getting me at my best. I'm actually better on Zoom than I am in person. I'm a geek. I'm a little bit of an introvert, and so I've never been the person who is like great at standing in front of an all hands meeting in front of 150 people and just saying like, go get them, team. We are a fully remote team at this point. We've always had some remote employees, but now we are probably 15 or 20% Philadelphia based, and everybody else is located throughout mostly through the continental US. And as a result, we've switched to a fully asynchronous culture. We Zoom record every one of our meetings and put links into meeting minutes. We push as much as we can to written communication. We use Notion very heavily for that. And I'm a pretty good writer. And so to me, that's been like, how do I invent a new way of leading a group of people and showing up as a human and like creating buy-in and the same kind of energy that you might have in an office, but doing it when you're not actually physically, close to these human beings.
Bob, in your experience, kind of having lived through different cycles and with early stage companies, how has this been different, and how do you see things changing for you, kind of, or the things that you've learned during this kind of remaining beyond the pandemic?
Yeah, I think I can be an optimist to a fault in some ways, and in looking for the silver linings around some of the impacts here. I get a lot of questions about how do you manage it's very, very similar to what Tristan just described. Not quite as extreme, but more than half of our team now is non-Philly and remote, and more than half of our team has been hired since the lockdown started. So, more than half of the people at the company have never met anyone else from the company in person. Mm-hmm. And I would actually argue that in a hyper growth environment where you're growing 2 to 3x every single year from a staffing standpoint and on other metrics, there's some real nice things about having a fully remote company, because when just the management of like the physical logistics of office space, desk allocation, conference room management, who's able to get the Zoom room that's got the good microphone in it, who can have a meeting with 7 people because they all fit in the big like boardroom conference room. You don't think about these things, but like, particularly in dealing with like corporate real estate where you fight hard to get a lease that's 3 years long, let alone the default of 7 or 10. You just can't realistically, practically have a hyperscaling company in one concentrated geographic environment without there being these layers of internal and external politics and economic commitment that get really, really hard. And frankly, suck away strategic focus from founders and senior leaders whose time would be better spent on other things. So we've been able to triple the size of our company over the last year and not have to have a single screaming match between, a sales rep and a CSM who needed the same conference room at the same time and got it double booked. And these things may sound little, but they can just be these incredibly toxic undercurrents that exist inside of the personal relationships between people. And I think I agree with Tristan, like being a fully remote company forces you to be significantly better at coalescing the understanding of what's going on at the company, what's the most important thing, what should we be focused on, how do we talk about it, what's the vocabulary of our business. And you can't rely on the grapevine for getting some of that stuff out. You have to centralize that knowledge, and this has been a forcing function for doing that extremely well. And I think the companies that have discipline around that or take joy in it, they benefit. And I think it actually does. It furthers this push we were talking about with capital allocation, which is the companies that figure out how to do that well, it will create this self-fulfilling prophecy where they become the ones that succeed in scale and therefore get more capital and therefore succeed in scale. So yeah, I think that that's the upshot is I actually think it's been easier to grow faster in this environment than it would have been if we were all cramming humans into a 10,000 square foot office somewhere in Center City.
That's great. And I'm going to pick up on Bob's optimism to round this out because we have a few minutes left. But I'd like Emily, Chris, and Matt to weigh in on this as well. And maybe where we can finish is if each of you could share kind of the one thing that you're really excited about coming out of this last year, whether that's with your portfolio companies, with your pipeline, with your own business in terms of process, or anything else that that you've kind of picked up on and that you're excited to take forward from this point on. So why don't we go Emily, Chris, then Matt, and we can close it out.
Sure. So there's a lot to be excited about, but I think the thing that I'm most excited about is that venture has a serious diversity issue. And I think 2020 really crystallized the need for us to do better, to not only from improving diversity from who's investing, but also kind of who are the founders that are getting those dollars. And then, just to have a much more inclusive community. And I think 2020, the pandemic really exposed massive, diversity issues, which we all had been talking about forever. But I feel that there's a real forcing function that's happening. And I know that Bob and Tristan think about it, not only from a team perspective, but a board perspective, and investors are too. And so I'm excited that is an output of the pandemic.
Great. Chris?
Yeah, certainly agree with Emily on that comment, and think it's really, it's getting the attention it deserves and should have had for a long time, but it's certainly a focus for a lot of firms today. I think another thing I'm excited about is, people talk about creative destruction, but the last year has changed a lot of things around the way that that we live as human beings on this earth. And I think that it has led to an adoption of technologies and solutions, frankly, at a pace that I don't think would have happened if not for the pandemic. And I'm excited about how some of those technologies can make everyone's lives better and allow us as a society to get there faster.
Great. Matt?
Yeah, I would certainly echo, what Emily and Chris said. I mean, I think kind of building on top of that, what I'm interested to see here is, what is the new norm, right? I think the new norm is going to be some kind of hybrid, balance here where we are back in the office, but, I think we're all going to be searching for a good work-life balance, right? I know that is, something that I look at with our team because, in this virtual world, I mean, you're kind of just always on, right? And that's great. We've been able to do really, really well and be very efficient, but to an extent, I think it's also unhealthy, right? So I think it's, how do we get back to a new norm and also make sure that we've all got, a very strong work-life balance within that new norm, and to Chris's point, leveraging technology to help do that. So, but yeah, I'm very excited to see where we go here in 2021.
Great. I think we made it just under the wire, and we have a question that I'm going to throw out to the group, and if anyone has, just even a quick thought that might be helpful. So the question is from the founder of an early stage pre-seed company that's in the education space. They don't have a lot of experience raising capital, and they're interested in, early on, I guess during the pandemic, they were focused on survival, as many were. And the question is, what do you recommend to start building relationships with investors in this environment? Obviously, things like this that PACT provides to the community are incredibly valuable. We talked a little bit about networking, but it'd be great if anyone has thoughts, maybe a couple of seconds on what your kind of number one best practice would be in terms of building relationships for fundraising in the future. And Chris, why don't we start with you?
Yeah, I think my only thought around that is that we live in a world now where I think investors tend to specialize. And when I think about K-12 education, that is an area where I know there are some very specific firms who either all they do or most of what they do is in the education space. And obviously, just given the dollars, a big part of their portfolios are in K-12. Those folks are always interested in talking with new companies, new solutions, new ideas that are out there. That's their stock and trade. And I'd encourage, not necessarily because they're going to be the right financing partner. I don't know if they are or not, but I think that they're going to be interested in speaking with you. They're going to be interested in hearing the story. And I think their networks will be able to point you in the direction of where you are in your journey fits best with potential capital providers.
Great. And we've got a few seconds left. So if there's anyone who really wants to add on or share anything, please do.
I'll just add real quickly. I was an ed tech entrepreneur, so feel free to reach out to me and I will do exactly what Chris said. I'll introduce you to all the folks in the ed tech investing world.
That's great. Thank you. Excellent. Well, we did it. We made it in an hour, and I think it was a great discussion. I really appreciate the perspective of each person on the panel who participated, and hopefully for those who are listening, it was valuable and gave you some things to think about coming out of the